All right, welcome back everyone to another Instagram Live with TGG. We're here today in the oasis of Max's Garden, and we're here to talk to you guys today about the state of the market. It's October 13th,
I think so.
2022. I think
Luckily not
last time I
Friday, it's
checked.
Thursday.
And lots been going on, even just over the past couple of weeks. So
It's crazy.
let's get to it.
Yeah, and I think, we've done a couple of these, and I wanted to keep doing them because you turn on your TV, there's a bunch of talking heads talking about the stock market, the real estate market, the inflation, the groceries, the gas, and I think it's just so important because everything's changing so rapidly. It's been so dynamic. It's so good to check in on these things, especially real estate, because it's rare that you have people on TV talking about what's happening with multifamily, with income properties. Maybe they're talking about homes, right? They're talking about home prices, development. They're talking about mortgage rates, but they're not talking about income properties and what's going on the investment side of real estate. So that's what I wanted to dive in today of like, what's really going on that they're not talking about.
All right. So today we're going to cover interest rates, super hot topic, as hot as it gets. We're going to talk about rents. We're going to talk about construction costs. We're going to talk about the sales market. So we can dive in with the, was it the 500-pound gorilla or the pink elephant?
Well, now it's 575.
Exactly. Talk about the interest rates. So it feels like ancient history at this point where you could borrow at 3.25, 3.5%, but really it was just in, January, February.
Even March, April, we were closing 3.4, 3.6% interest. And I remember we bought a deal in Inglewood at 3.6, and the investor was like, what do you guys think? Is that good? Is it not good? And now we look back and we look like geniuses that we got that rate. Because now we're buying a 10 unit in Mar Vista, and initially the rate was like 5.25, and then it became 5.5, and then banks were dropping out of the deal, so we're actually getting 5.35 interest rate, which today is amazing. But I would say the average market on multifamily in LA is if you're going to get debt, you're probably looking at 5.75, and pretty soon we think it's going to be probably around 6.
Yeah, which everything is relative to expectations, right? And also relative to pricing, where you're what cap rate, what yield you're buying the property at. But so in addition to the rate, I think the other thing to touch on is the leverage, right? So where we were buying properties and putting 30, 35, 35% down payments, now it's easily becoming 40, 45, 50% down. So the leverage is also a hot topic. And then,
well, really quick on leverage, I think the reason why and why we're seeing this shift in the market, right? You have a lot. It's not just the interest rate. It's not because I'm borrowing at a higher interest rate. It's what does that higher interest rate mean? If I'm going to buy a $5 million property and I used to be able to get a $3 million loan, maybe now it's 2.5. And the reason why is banks are underwriting to income. So if the income stays the same, but my loan payment goes up, that means I get a smaller loan. And now if I were to pay $5 million for the property with a $3 million loan, if my loan's now 2.5, I may only pay $4 to $4.5 million. So what we're seeing is that a lot of buyers are saying, well, the pricing at $5 million that I would have paid 6 months ago just doesn't make sense anymore. I can only buy it for this price. And now the question becomes, and we'll talk about the sales market, is a seller willing to meet that new marketplace of where buyers are going to buy property? Because if I have to borrow, and we talked about this in our interest rate video a couple months back, it's like if my borrowing costs go up and I need the same return on my money, I'm going to have to pay a lower price. There's just no other way around it.
Which is what we're doing in Mar Vista, right? So we were prepared to pay a lot higher, 4.7, 4.8, or in that ballpark. We were ready to pay that price about 6 months ago. The seller wasn't ready to sell there, and all of a sudden we came to an agreement to buy it for 4.2, which is obviously a lower price, but the numbers for us haven't really changed that much because our borrowing costs have gone up so much. So essentially, you can get a good deal for today's market if the seller's motivated and will meet the market pricing, because a lot of buyers are on the sidelines, which is what we're still doing. We're still buying. But just because it may look like a good price compared to what it was 6 months ago, the returns may be equally attractive or less attractive because of the higher borrowing costs.
But the one thing that I like is I feel in the long term, and I know we're probably going to talk about this, but like in the long term, we feel like we're getting somewhat discounted prices because there's fear in the marketplace right now, because a lot of buyers aren't in the market. It's giving us the opportunity to get deals at pricing that we think is, hey, it's good relative to today's market, but it's great relative to where we think we're going to be in 3, 5, 10 years.
Exactly. Yeah. So we talked about interest rate, leverage, and then the one other thing to talk about in the debt market, and then we can move on, is the lenders that used to be super active in this market. Some of them have just gone completely bye-bye, meaning they're still operating as banks, financial institutions, but they're saying, we do not want to lend on real estate. And if we do want to lend on real estate, obviously the rate's going to be higher, the leverage is going to be lower, and we're going to be pickier about who we lend to, seeing more track records, basically trying to make it more difficult to make deals pencil, which 6 months ago they were competing for the business, and now they're going, I don't know if we really even want to be doing this right now.
Exactly. And then if we look at rents, the next hot topic is, I think rents have become very strong, but they've stabilized. I don't know if they've plateaued. Maybe they've plateaued, but we haven't seen them continue to rise. And look, COVID for a year and a half, we saw them drop rapidly. We saw that climb back to where we should have been, plus increases above that, right? The rental market has definitely gone up from where it should have been without COVID. But now we're seeing it stabilize. And I think for us, when we look at our assets and we look at over the next 12 to 24 months, we're taking a conservative approach and saying rents may come down, right? If we go into a recession and income goes down, right? If unemployment goes up and income and wages come down, what's that going to do to our rent? So we're taking a very conservative approach, looking ahead of rents being stable, probably maxed out, to even decreasing. Now, is that what's going to happen? I mean, who knows? Rents could go up another 10, 20%. But we'd rather be conservative, especially just given what's going on in the world.
There's still definitely a shortage of apartment units in good quality locations, specifically on the west side. There's definitely a shortage of housing units. It's very hard to build out here, and there's just a lot of people that want to live out here. So there's definitely a shortage of housing units. However, if the market takes a dip, then rents could still come down, I would say, on a temporary basis.
And I think what LA has shown is that the dip isn't as severe in the rents, and also vacancy stays about the same. We're not going to see crazy vacancy rates in LA, because people are still going to want to live for apartments.
Office, different story.
Let's not talk about that. We just left our office. I mean, we've been talking about it. Now we're working out of my house. But I mean, we haven't seen. If anything, we see that our vacant units are leasing faster than they were before at these higher rents. But I think next is construction costs.
Basically gone up. That's basically it. Construction costs have gone up.
Well,
we could talk about why that is.
I think first and foremost is like trade labor has been really hard to lock down between plumbers and electricians, even a roofer. We use this one roofing company they've been doing a tremendous job, but we can't get them to our properties for a month or 2 months. The beauty is that, I mean, it's funny, it just rained in LA, but and fortunately, we actually just finished. We re-roofed an 11 unit in Inglewood, and it got done Friday. I mean, what timing? But it's like we're okay with it because it's not rainy season yet in LA for the 5 days in January that it rains. But just finding skilled trade labor has been really tough and more expensive. We're repiping, redoing the entire plumbing in our property near downtown, and a repipe that probably would have cost us 40 to 50 grand 2 years ago is now costing us $70,000.
Right. I think part of the reason why the vendors and the laborers are very busy is because of the housing boom over the last 2 years. So many people have purchased homes, and when you buy a home, especially if you're going to live in it, a lot of people are renovating the home, they're putting on new roofs, they're bolting foundations, they're upgrading electrical, they're doing
all the appliances. Like people are trying to get appliances, you can't get them because more people are buying them.
Yeah, so it's very possible that construction costs will come down as vendors get less busy over the next couple of months. Still some logistical shortages and slowdowns. Of course, coupled with inflation, as the cost of goods has gone up, but we'll see what happens with construction costs over the next 6 months. But what we can tell you is that they've gone up tremendously over the last 6 to 12 months for sure.
And so if we take all these factors in consideration, we look at the debt market, we look at rents, we look at the economy, we look at construction costs. What's gone on is that a lot of people are saying, hey, I'm probably better off right now, unless I can hit a home run on something, unless something just makes way too much sense, I'll sit on cash. And so there's a lot less buyers in the market, and it's slowed down. I think all these factors have contributed to a major slowdown in the sales market, in the transaction market. And we're seeing a lot of properties come back on the market.
Oh, yeah.
Price drops. I probably have gotten 15 emails today alone of price drops. And ultimately, I think what's going to happen is the buyers are kind of setting the new market pricing, and unless sellers are motivated, right? We've talked about motivating factors. I mean, unless they're saying, hey, I'm just not going to own, so find me a buyer that's going to close at a price that's reasonable.
Call us.
Yeah, well, that too. It's like then they're not going to sell, and so so a lot less transactions, and I think prices are really coming down right now.
Prices are definitely really coming down, like you said. Things falling out of escrow, back on market, price reductions, for good reason, because if a buyer was in contract assuming that they were going to borrow at 4.5% and the lender comes back and says, no, it's 5.6, obviously the numbers don't look as appealing. So those buyers are going, you know what, I'm just going to cancel and move on, unless the seller will give me a massive discount.
Exactly.
So here we are. I feel like we kind of had this conversation, like kind of feels a little bit like deja vu when COVID hit. When we first started doing these Instagram lives, but I think the difference is that that was before they started printing all the money. And now the money's already printed.
And now they're taking back that printed money, which is scary. And I don't look. I'm not an economist. I haven't been doing this.
An engineer.
And I'm an engineer. I haven't been doing this for 50 years. I haven't been through all the debt cycles. But we're definitely taking a much more conservative approach, expecting things to continue to get worse. But we are still buying, right?
Still buying.
We bought the 17 units in Hollywood. We're buying in Silver Lake right now.
11 units,
11 units in Silver Lake. We're buying 10 units in Mar Vista. We're going to continue to buy, but I feel like we said this a million times. We're always adjusting to the current marketplace and also where we see things that are where they're going to be for the next 12 to 24 months.
Where we can comfortably anticipate that we'll be able to anticipate a business plan and perform for our investors. That's what it comes down to.
That's our crystal ball. I think we don't know if it's going to be better or worse, same, but as long as we can do right by our investors, buy properties in good locations at great cost basis, we maintain an optimistic view on LA, multifamily in LA.
For sure.
And so with all those things in place, we're going to keep buying.
Hope you guys enjoy this Instagram live. I think that's everything to wrap it up.
How could they not? I mean,
it's beautiful, right?
Even if they didn't like what we said.
Maybe next time we'll do it live. People can come, be in the audience. Thanks for watching. If anyone has any deals, questions, comments, want to invest with us, please feel free to reach out at the Goldfinger Group, at Hueliyahu, max at thegoldfingergroup.com. Until next time.
Thanks.